Hello, everyone. Welcome back. We are here with another episode of our Digital Traders Summit, and I welcome you warmly from our enmacc offices here in Munich. 2 weeks ago, we had a great discussion on the gas markets and the tumultuous developments we have seen there recently and the outlook for the next years to come. Today, we want to take this midterm perspective and connect the gas markets with the power prices. And we have invited from ICIS, Matt Jones. He's leading the power analytics team, and he will share his insights together today. As always, we invite you to participate. Please use the chat functionality to drop your questions. I will pick them up. And after a short presentation, we will get right into it, discussing these. I'm looking forward to it. Handing over to Matthew. Thanks for joining us.
Sure. Thanks, Jens. Let me share my screen, first of all. Shall we get that working? You able to see that now? Is that working?
Yes.
Great. So, yeah, thank you for the introduction, Jens. My name's Matt. I'm head of power analytics at ICIS. So firstly, want to thank enmacc for the opportunity to speak here on this topic, which is will gas prices continue to drive European power prices? I think it's a question that's been much discussed over the past few years. I mean, firstly, because of the energy crisis in 2022. So there's a lot of non-power market people who suddenly took an interest in European power markets and discovered that marginal cost pricing meant that though gas made up a fairly small share of the power mix, it was the biggest factor in setting power prices. And so there was a lot of discussions around whether power markets should be reformed. And those discussions have by no means gone away over the past couple of years. But I think it's also received attention more recently because of the massive growth in renewables. And so something we get asked a lot by our customers is whether we see the relationship between gas and power starting to loosen in the next few years as renewables take an ever-increasing share of the generation mix. And so that's what I plan to explore today. So for anyone who might be unfamiliar with ICIS, we've historically been known as a price reporting agency. We have the benchmarks for TTF and NBP prices, but we're also an analytics company. And in the energy space, we have products covering LNG, gas, power, and carbon. We try to take a cross-commodity view, given the close connections between each of those markets. All of our models interact, and we've got a team of just over 60 analysts across those commodities. So I'll be trying to draw on certainly 3, if not all 4, of these elements in the presentation today. So the agenda. I'm going to start by talking about the historical links between gas and power prices in several European markets with some correlation analysis. I then want to introduce some modeling. So I'll present our views on the contradictory drivers for the role of gas in the next 4 years, and some analysis of what technology actually sets the price in European markets and how does this evolve over time. And then in the third section, we'll look at our views on how gas prices are expected to evolve, given the changes in global LNG supply and demand, and the impact that this then has on power prices. So let's start with the link between gas and power prices. And I focused here on the month-ahead contract, which has the strongest correlations. It's actually slightly stronger than year plus 1, which might be slightly surprising to some people. And what I've done is to pick 6 European markets, but then try and group them in pairs based on the similarities. So the graphs are showing that annual correlations of the rolling month plus 1 contracts for gas and power in each country. So if we start top left, you can see GB and Italy, 2 gas-dominated countries in Europe without significant fuel switching capabilities. And here you can see extremely strong front-month correlation between gas and power over the past 5 years, correlation coefficient of more than 0.95. Secondly, then you've got Germany and the Netherlands, both markets that have significant gas, but also coal capacity, meaning that fuel switch is in play. But even here, we've got gas power correlation on front month contracts that's still really strong over the last 5 years, 0.9 or above in both countries. And then thirdly, you've got France and Spain. And here, gas can play a smaller role at times because of the combination of nuclear, hydro, and solar and wind in those markets. But we're still seeing pretty strong correlations. So 0.81 in France. Spain is weaker at 0.69, but that's really a product of the result there you see for 2022, where we saw this negative correlation during the energy crisis. So if you ignore 2022, then Spain would actually have a stronger correlation than France at 0.87. So what this is telling us is that across all these markets, gas and power are really moving together on the front month, with only relatively small differences across countries. Now, this is where it gets a bit more interesting. So this is the same data as the previous slide, but it shows month plus one gas power correlations as monthly rather than as annual results. And you can see that we're starting to see some larger differences across the markets. So in the gas-dominated countries, GB and Italy, the monthly correlations have remained strong in pretty much all months across the last 3 years. So highlighting really that gas is the dominant driving force behind power prices. But with Germany and the Netherlands, you can see in 2024, again in March 2025, which is the front month for April, you could argue that we're starting to see the impact of solar generation on these dynamics as the correlation begins to fall in these spring and summer months. And you can really then see that if we look at France and Spain, where at the monthly level, we're seeing correlations breaking down. Most frequently, again, it's doing this in the spring and summer months as demand initially falls, solar ramps up, and gas is increasingly then pushed out of the mix. So the question is, what is expected to happen to this relationship going forward between gas and power? Are all countries going to start looking more like France and Spain in the next few years? And I think there's some reason to make that argument, given that Europe's expected to continue expanding its renewable capacity at a pretty rapid rate. So this graph shows our base case renewable generation forecast out to 2028 for the whole of Europe, which for us is defined as the EU plus Norway, Switzerland, and GB. And we're expecting solar and wind growth of around 15% per year on average, with wind and solar share of generation increasing from 28% in 2024 to 43% by 2028. And if you had hydropower on top of that, as I've done in the right graph, you can see that the total share of generation from those two sources is forecast to increase from 45% in 2024 to 58% by 2028. So you've got this really rapidly rising renewable generation eating into the share of other technologies. So does this lead to less of a role for gas? Well, before presenting that data, there's a few additional things to think about. So one is demand growth, which we expect to be pretty modest this year, around 1.5%, increasing gradually to 2.2% by 2028. And interestingly, you can see there on the right graph that we see the electrification sectors really dominating this demand growth. So by electrification sectors, I mean data centers, heat pumps, EVs, rail, and electrolyzer demand. And they're forecast to account for 65% of the demand growth over the next 4 years. So the traditional sectors, industry, commercial, residential, are only expected to account for the remaining 35% of that demand growth from those sectors that are still recovering from the crisis. But also interesting to think about the trends in other technologies. So one of those being nuclear, where you can see our expectation for a gradual decline in output over the next few years. So this is caused mainly by developments in 4 countries. So firstly, permanent and temporary closures in Belgium, which start this year. Secondly, you've got the permanent closures in Spain and GB from 2028. And then thirdly, you've got France. So what we've started to see is EDF optimizing that French fleet when prices are low in order to save on fuel costs. So the idea is, as France ramps up its solar capacity, we expect to see even more of this kind of modulation of the nuclear fleet, and therefore slightly less generation year on year. And the final most important thing to consider is what happens with the fossil fuels themselves, both from a capacity development and spreads point of view. So on the capacity side, we see coal and lignite phase outs in Germany and Eastern Europe, leading to a 32 gigawatt fall in capacity by 2028. Should be said that not all of that goes off of the market completely. It often goes into supply reserve, but it's not available to the energy-only market. And at the same time, we've got 28 gigawatts of additional gas capacity coming in Europe. But then we've also got what happens in spreads, which is even more important. So currently in favor of coal over gas in 2025, but that's expected to switch from next year. And by the time we get to 2027-8, we see gas having a significant advantage over both coal and lignite. And I think it's worth noting that this is based on the forward price of carbon, as all of the graphs in this presentation are. Whereas we as a company actually take a bullish view of carbon price expectations because of the tightness that comes in that market from next year. So that could mean that gas has an even bigger edge over coal and lignite. So we've seen that we've got these competing trends that are taking place over the next few years. Where does that leave the role of gas within price setting? So again, I'm looking at the countries here in pairs. And in the top graph, that shows you the annual share of price setting that's coming from gas plants. Whereas the bottom graph is the same data, but at the monthly level. And I've selected there just gas and the other technologies that are relevant for that country, as well as the linear trend in gas. So what we see in Italy and GB is that the gas share of price setting remains really quite solid over the next 4 years. We see a very slight decrease in Italy as the impact of solar in price setting seen in the spring and summer months. GB, it's slightly larger decrease, but it's still pretty modest. But it is more evenly distributed across the months, and that's because of the role of offshore wind in GB, which means that you've got winter months as well, where gas can be pushed out of the mix for more hours. But it's not a significant change that we're seeing over the next 4 years in both of those markets. Germany and Netherlands is a different trend. And as I said, because of the combination of this fossil capacity changes, and particularly the spreads changing in favor of gas over coal, what we actually see is an increase in gas price setting over the next few years. That is still being tempered by the impact in the spring and summer of more solar, pushing gas out of the mix. But in terms of weighting, you can see that it's more important that gas is replacing coal and lignite in price setting compared to renewables replacing gas. And then finally, if we look at France and Spain, it's a different trend again. So you can see France, gas is already playing a pretty minor role in direct price setting, with nuclear and hydro taking the lead. Though even here, I think we should note that the way hydro prices in the market can be quite complex to understand, and it's often, to an extent, undercutting the short-run marginal cost of the most efficient gas plant, or shadow pricing. So here, gas prices can still have an indirect impact on price setting, hence why we've seen still a pretty strong correlation between gas and power. But what we can see is this trend again of solar starting to eat into the gas share in the spring and summer months, and then you really see it in Spain. So that, I think, is the biggest outlier in the countries that we've looked at here, where you can see that the share of gas within price setting falls from 47% to 43% by 2028, And again, principally because of what happens in a certain number of months a year, where gas is really pushed out of the market. And so finally, let's look at the 6 markets together. And what we see is these contradictory drivers kind of balance each other out. So you've got the increase in solar and wind price setting, but the decrease in the share coming from coal and lignite. And what that means for gas is that its share of price setting remains pretty unchanged over the next 4 years. Increases slightly in 2026 on fuel switch before declining a bit in 2028 with the impact of renewables. But essentially, it shows that the gas price setting isn't really going anywhere in Europe in the next few years. So given that's the case, the final section to look at is then, well, what do we think is going to happen to gas prices themselves? The biggest trend in the past 3 years now has obviously been Europe's pivot away from Russian gas towards reliance on global LNG. So you can see in the left graph that LNG accounted for only 17% of Europe's gas supply in 2021, but that's grown to more than a third in the past 3 years. And we forecast LNG to account for about 42% of European gas supply by 2027-28. And crucially, it's not just the share, it's the role that LNG has within price setting itself for gas. So since it's the flexible source, it also has become the marginal source most of the time, with competition between Europe and Asia to attract this LNG, the most significant driver for European gas prices. And in the last few years, the global LNG supply and demand balance, which we forecast as a company, has been in deficit. So in other words, demand exceeding supply. But that is expected to change once we get into next year, which is looking pretty balanced. And then the market turns long from 2027 onwards. And the main reason it turns long is the significant expansion of new liquefaction capacity that comes online. So principally from North America at first, US and some from Canada, and then also from Qatar and to an extent Africa as we get further into the decade. So what I've tried to do in this graph is to highlight how this changing supply and demand balance influences European gas prices. So if we go back to the 5 years pre-crisis, the ICIS TTF price averaged $5.2 per MMBTU, and prices just very unlikely to fall back to that level, given the change in the marginal price setter of gas within Europe. So instead, the way we think about it is that the floor price being determined by the cost of US LNG into Europe. So in other words, the cost of Henry Hub plus liquefaction and transport, which you can see there in the black line. So Europe's been faced with the prospect of having to outbid Asia for that scarce LNG. But as that supply and demand balance starts to change, you see the TTF curve moving lower, and you see it getting closer to the expected price of delivered US LNG into Europe. So that's really the dynamics for why we see European gas prices expected to fall. So finally, what does that mean for power prices? And I've again tried to keep the markets in pairs here. And what the bold line shows for each country is the base case price forecast for the market out to 2028. And you can see that all the markets are strongly backwardated, really reflecting that backwardation in gas and highlighting that gas is, the main driver of each of these markets. However, what I've also shown here is a dotted line for each market, which is the implied forecast price if the power price moved only in line with gas prices between now and 2028. So what we see is a growing delta between the forecast price and the implied price for each country. So that delta essentially represents the extent to which non-gas price factors are moving the forecast, or to phrase it another way, shifting the merit order to more efficient plants. And you can see that the impact is strongest in Italy, the least strong in Italy and strongest in Spain, which aligns to the data that we showed earlier about the role of gas within price setting. So to conclude, what the data is essentially showing is that while price direction will largely follow the trend in gas prices, we do see the impact of increasing renewables in at least shifting the merit order to more efficient gas plants setting the price. So while we're not yet at the stage where the role of gas itself within price setting is significantly being reduced outside of perhaps Spain, we are in a position where renewables are starting to significantly move the merit order to more efficient gas plants, which is obviously bearish for power prices. So thank you very much for the chance to present, and happy to take questions or have a discussion about it, Jens.
Yeah, thanks a lot, Matt. Amazing, very good. And I personally have already some questions while we wait still for more questions to come in from the audience. One on the starting maybe a little bit technical. You looked at the front month prices and their correlation. Have you widened the scope a little bit, looking as well on the yearly contracts or even spot? Is that the similar picture, or what informed your choice to look at the front month as a basis for correlation?
Sure. Well, I looked at front year and front month, and I was going to show both, but for time restrictions, I decided to keep it to front month. Interestingly, the front month correlations were stronger than front year, which I was slightly surprised by, because given things like outages can affect the power market without affecting the gas market, I would have thought that front year may well be stronger in some of these markets, but that wasn't the case. Once you get down to, say, day ahead, I actually didn't look at the data, but I think it's been true for quite a while that correlation would really break down. That you'll see, the whims of forecasts for solar and wind generation on a daily basis make a big difference to the movements in power prices.
Yeah. We get one question just to basically reiterate that. You looked at on the yearly level, but you looked as well on the monthly level, and the monthly patterns show that there's still a clear breakdown of some of these correlations in summer months or other periods of a lot of renewables. One as well, maybe a little bit technical question, but I like the idea of blending the markets then showing this European picture. Are the interconnectors modeled in your approach, and what kind of role do they play? Mixing basically the different pricing effects.
Yeah, I mean, interconnectors are included in our model. So our model has 42 European bidding zones. So the interconnectors, are modeled across each country. Do you mean how much are they influencing what sets the price?
Yes.
Yeah, it can be a bit complex. It depends on which market we're looking at and whether or not the whole of that interconnector capacity is used up to see if you get price setting that comes from another market, or whether you're just shifting the merit order within your own country to have a plant set there. But yes, price setting can certainly come from other markets and not simply your own one.
Yeah. So specifically now you contrasted the markets, France and Germany. So there's no specific expectations regarding more interconnectors or specific effects, how they interact the markets.
Yeah, I think there's a question on how much interconnection Europe gets. I mean, we can see that there's some projects going forward, but the EU aim is to say, well, let's reduce differences across countries. But we've seen, for instance, with the Nordics, Norway recently saying, no, we don't want to be doing that. That's the thing we dislike. So I think there is a question mark as we go out to say, does Europe build a lot of interconnectors to create the most efficient system, or are there national reasons for saying no? We don't want the negative effects that can bring.
All right, we get a lot of questions about the gas market itself. So discussions around end of the war, Russian flows maybe starting again, even driving prices further down. We don't have to go into detail, but maybe you could a little bit share with us your assumptions in this model, or what kind of approach you took there.
Sure. So I mean, you can see in our base case when I showed the slides on the different sources of gas that we don't expect any return of Russian gas within our base case. I think there's an argument about the flows that were cut off at the end of the year, where there's obviously a big push from some of those Eastern European countries to get the flows back that were coming via Ukraine. But I mean, I found it odd when the market was moving down sharply a couple of weeks ago. You'd speak to a lot of traders and other market participants, and everyone says, well, the assumption that Nord Stream 2 might restart is moving the market, but everyone thinks that that's stupid, that it's just not going to happen. Everyone that I've spoken to. So I found it slightly odd as a dynamic, if that there were other things that were also moving the price down, but if that is moving things, I find that quite surprising. I don't think that's a likely outcome from a political point of view, and also from a point of view of, the contracts with Gazprom where people are owed money, how does that actually work out, etc.
One very concrete effect we have seen of these debates is the inverted summer-winter spread right now. Any comment on summer-winter spreads going forward and how they affect the power market? Do they translate directly on the power side?
Probably best not to go into details there. So, I am a power analyst, not a gas analyst,
Yeah.
so I haven't followed the summer-winter spread dynamics as closely as the gas team would here at ICIS. To see, ultimately it'd be up to the regulator to step in if those spreads are not the way that they would need to be. But yeah, it's a good question on how that's actually influencing the power market at the moment. Presumably, keeping prices a little bit higher than they would otherwise have been. But that's something we haven't analysed that could be worth doing so.
Yeah, I find as well interesting topic to see some seasonality patterns there going forward. We discussed it briefly before as well. On the demand side, you show a kind of a rather steady growth of demand. Clearly, let's say, relating to the German prognosis we have officially well below. So we have all, I think, more tamed expectations regarding growth. But they are AI data centers and other topics clearly driving it, or other electrification topics like transport. Do you see there a specific sensitivity as well to price levels? So you talked about a recovery a little bit from crisis. How much is the demand sensitive to price levels going forward? And are you considering this in your model?
I mean, that's a very difficult question. We were discussing it only yesterday as a team. But particularly on the industrial side, everyone wants to know, how much of industrial demand destruction is permanent, how much of that is going to return, and at what price levels. Which it's a very difficult question to answer. The other half of what ICIS does, apart from energy, is chemicals. And obviously chemicals is 20% of industrial demand, the biggest subsector. So we do take a view there on where we see that the market going in Europe, and it's a pretty negative picture in terms of the chemicals sector. Margins remaining pretty low, massive oversupply in that market for the rest of the decade. With the electrification sectors, I mean, we did a big study that came out last year on data centers, where we had a methodology for breaking that down across countries. But maybe more broadly on demand, yeah, we see it as being relatively modest growth. But some of the assumptions from a couple of years ago from countries like Germany seem significantly over-optimistic when it comes to heat pumps, or electric vehicles, or hydrogen. We've downgraded our forecasts for hydrogen again recently, because our project database says that the market's moving a lot more slowly than people were thinking perhaps last year or a couple of years ago.
Spinning this further, this price sensitivity, it definitely helped to have high prices for the build out of renewables last couple of years. So going forward, if we see this, the prices falling due to lower gas prices, do you see there any effects on the further build out?
Yeah, definitely. I mean, we can see it's not just the decline in the wholesale price, it's the decline in the capture price, which particularly for solar falls a lot more sharply than the wholesale price because of the impact of cannibalization. So we see that as a big problem as we go for the rest of this decade and into the start of the next decade. there's a lot of subsidies still around from governments trying to reach their targets. But if you want to move to an unsubsidized world, that is very difficult without building up a huge amount more flexibility to try and protect from these negative prices and low price periods.
But in general, you would not say there's a certain price level where the build out will suddenly be reduced significantly, or where we go back to a fully subsidized build out in Europe. Is this part of your considerations?
Well, what we see that, particularly until 2030, that governments still very much have their targets to be met. And the assumption is that the subsidies, for the most part, get you towards those targets. What we see in our modeling is we move after 2030 to a more unsubsidized environment. And we see a fairly significant slowdown in renewable build out until those capture prices are able to recover enough to keep your levelized cost below your capture price.
Yeah, exactly. Which leaves a question mark. If the subsidies are supposed to run out, but the prices drop too much and we get more dependent on renewables in the price setting, then there is a big need probably for subsidies to come back to the market to stabilize that.
Yes, or the alternative is the carbon price.
Carbon price.
A lot.
Yeah.
And so, even if you've got this falling share of gas, which, not happening this decade in our view in most markets, but will definitely happen next decade, with fewer hours of gas setting the price, you need the price that it's setting at to be a lot higher. And if the gas price can't do that, then the carbon price is the obvious thing that can help lift those capture prices.
Yeah, you said your own estimates are rather bullish on carbon price. What were the kind of price levels you see there at the moment, 27 onwards?
I don't have them in front of me, so I probably shouldn't.
Bullish.
Shouldn't quote, but by the time we're getting into 2026, 7-8, we're well north of 100 euros per ton. The market's structurally short from next year and into 2027, and our view is even this year you should see speculator activity coming into the market because of the assumption of the price going up for next year, and we've already seen that. So, did the correlation of gas and power? There is also a correlation of carbon and gas, and so the carbon price will continue to follow the gas price, but it's also got its own dynamics.
Yeah, very good. Yeah, there's as well this very strong correlation we see, and or probably will continue to see as well. I mean, overall, your results are quite comforting in a way that you say the markets will continue to work as they do, at least in Germany and other big markets. But then there's Spain. Is Spain a little bit giving us information where we are heading? Is Spain leading or a good example where other areas will end with an increasing share of renewables?
Yeah, I think Spain's a good kind of warning sign of what can take place. There's good parts and bad parts to it. So I don't want to make it sound too negative, but it's got a very high share of renewables because it's built out so quickly. But that trajectory should be seen in other countries where renewables eat into the fossil share. And the problem that we're starting to see in Spain, as we touched on earlier, is these falling capture prices because of cannibalization that just makes it harder for the new projects to come online. So, what does that mean for the future build out of renewables in Spain? And then, what will that mean for other countries that face the same problems, but maybe with a delay of a few years?
Yeah, maybe a little bit of speculative question, but if picking up one question here, if we would see a price zone split in Germany, is then the north of Germany another Spain? Have you any idea or thought about this, how this could affect the pricing behavior?
No, I'd prefer not to answer that. I'm not. As you can hear, I'm not German, and it's not. We've got half of our team are German, so I can pass it on to them, who may have more views on that topic.
No, very speculative. Clearly here, looking forward. Another topic we have to touch upon, as it affects so much the short-term markets, spot markets, is batteries or any other way storage in a way. Does that play a role if you look on these in your model, in your thinking about price setting on a monthly or longer term basis?
Yeah, it certainly starts to play a role in price setting. You can see in some ways it's similar to how pumped hydro is able to optimize to decide when to come into the market when the price is low, and then when to give back to the market. So I said in relation to France that hydro is often trying to undercut the next plant in the merit order, which is often the most efficient gas plant. So it definitely will play a role in price setting going forward. I think there's uncertainty just about the capacity build out and about how much of that capacity is available to the wholesale day-ahead market at any given time. The business case is always revenue stacking. So, balancing markets, frequency response, etc., are the other markets that capacity can go into at any given time. So, trying to understand the exact dynamics of how much build out you get is quite tricky.
Yeah, and you said as well that some of the coal capacity is not leaving the market actually, but is still available in other ways to stabilize. You have this as well as part of your modeling.
Yeah, it will have to go into supply reserves. I mean, Germany would face some significant problems if it just decided to keep pace with its coal and lignite phase out, not build any new gas until sort of 2030. So yeah, a lot of that will go into the supply reserve as they've been starting to do in the last few years. But either way, because of the direction of spreads, that those plants will be pushed to the end of the merit order anyway. Inefficient coal plants from next year are not going to outcompete gas plants.
We'd like to pick up one question we got here just regarding correlations again. We mentioned the EU ETS carbon price very much influencing price setting as well. Do you see there any specific regional pattern? Which country is most affected by that? Is there any insight?
Which country is most affected by the carbon price?
Yeah, by the carbon price going forward. Yeah.
Sure. I mean, it's the countries that have the highest share of coal and lignite in their price setting. So Poland is undoubtedly the winner in that race. I mean, Germany's pretty high up that list. Then you've got the countries that rely more on gas. So Italy, GB is somewhere in the middle. And then the countries that are able to push fossils out of their generation mix for longest, obviously Norway at the extreme end, don't have much sensitivity to changes in the carbon price.
I would like to go back a little bit to your last slide, where you have shown the forecast price and then these implied prices. Provoked a little bit the question to me, is the market getting it right from your angle? If you look at longer term price levels right now, is this what you just shared with us, this correlation or this influence of the gas price on power prices well understood for the next years, or is there any bias?
Well, we see that across markets that the FAR curve is slightly overvalued, and that's a pretty consistent pattern. So in other words, the actual traded curve looks closer to the dotted line that I showed of, in other words, just assuming the same efficiency of gas plant sets the price. So moving in line with the gas price. Whereas our modeling suggests that actually the price is a little bit lower than that in most places, which I think is largely related to the things we've been talking about of what are the demand assumptions people are taking, what are the solar capacity in particular assumptions, and then also a question in some markets about how liquid and how fair a value of the price is that once you get out to year plus 2, year plus 3.
If we look now well above what maybe the model can clearly predict, when do you see a significant shift away from this correlation in power prices? When could be the right time? I've seen some estimates around putting this at 35. Is this something you can relate to, or what is your outlook?
Yeah, so I mean, we forecast out to 2050, but the price setting tool that I was relying on there is only attached to our midterm model to 2028. But I mean, you can see with the developments of what's happening in Spain there, that was starting to decline pretty quickly. And so it will depend on the market. But I think certainly over the course of the 2030s, that is where you will see the share of gas price setting fall across all markets. What I'm not sure is exactly the rate of the fall, That's what's slightly harder to determine without looking directly at a price setting tool.
Very, very good. Look, Beth, amazing stuff. Very good insights. I really appreciate that. I found it super interesting. And as well, big thank you, not just to you, but as well the audience who participated here with some very good questions. Very much liked it. Let's get back to this. We like to test your predictions, looking into this again in a couple of months or years and see how things are coming to life. Thanks again. Thanks for everyone participating. It was a real pleasure. Thanks a lot.
Cool. Thank you very much. Bye.